Good evening, colleagues, wherever you are. Welcome to this second webinar organized by the End User Subsidy Lab. Let me introduce myself. I'm Raihan Alahi. I'm a lead specialist working at SMAP World Bank. I lead the Energy Access Program of SMAP, which tends to support both electricity access and clean cooking access. Recently, we had been very much focused on the Mission 300 agenda and supporting the Africa region. But we also believe that, and there is data to show that there are other regions in Latin America and in East Asia where access is also falling behind. And we like to know that how can SMAP, with support of all of you, through the work that End User Subsidy Lab is carrying out, can actually achieve universal access. Off-grid will play a critical role, but it's not only the technology, but also the business models, which are very, very critical. So from that angle, let me welcome you to this second webinar series where we focus on energy as a service model. I think the first seminar series was focused on results from SolarAid's Lighter Village pilot. I think many of you participated in that webinar, and we would like to discuss and hear from you as you also participate in this webinar to see how this can actually contribute to your work program. Excuse me. So. What I would like to say is that the reason we focused on energy as a service model is what we found is that most of the areas where energy access has still remained a challenge is mostly because it is an affordability issue. Grid usually connects the people who can be connected physically, financially viable model. But then the rest, grid doesn't even able to go because they are not profitable areas for grid to serve. Mini grid also has the same problem because for mini grid also, whether the geographic area that are being covered has the right amount of load and demand is important for them to be financially viable and sustainably operate. But when it comes to off-grid solar, standalone solar, we have seen that cash sales and pay-as-you-go sales have contributed, but still now with the remaining people left without electricity, there's about 80% of them are affected with affordability challenges. The energy access challenge is quite peculiar because the more success we get, the more difficult it is to connect the rest of the people, because when you connect, you actually take the best of the lot out from the group. And the people remained in the inaccessible areas are ones who are more difficult and more challenging to connect. And this is why we have found that even with PAYGo business model, many people can't even afford even tier 1 level of access. So from that light, I think we'll discuss about energy as a service model to see whether this model can bring in change, whether it can bring in an additional edge to all the existing models, and can this new model, energy as a service model, be useful to bridge the gap that we currently have. With that, in the first seminar, we have introduced what this End User Subsidy Lab is, but just for the sake of those who has joined this webinar today, I want to introduce that End User Subsidy Lab is a partnership of SMAP, NDEV, GOGLA, and the Clean Cooking Alliance. And what we try to do is that we try to see that how can subsidies effectively benefit the end users? How can we make subsidy transparent and effective, and also bring in sustainable and meaningful change? So So this is what the focus of the Subsidy Lab is. And we must say that this partnership has been there for several years now. And we have worked jointly to see how we can benefit the knowledge part of it from donors, from development partners, from the industry, and so forth. And with that, I think I would request Jacob to take over from Energy Savings Trust. I mean, Jacob is the one who would be leading the way today with his presentation. So I'd request Jacob to come in and take us through. Thank you. Jacob.
Thank you so much, Raihan. And hello, everyone. It's great to be here. I am Jakub Verba. I work with Energy Saving Trust, where I lead our energy access strategy partnerships and research work. And can we go to the next slide, please? And today I'll be moderating the session. Over the past 18 months, we have been working closely with Ed Day and his team from Greencroft Economics to assess the potential of energy as a service to provide first-time electricity access. And as Raihan mentioned, we had the first session that looked kind of back at the Malawi and Light Village pilot that has been delivered by SolarAid and the successes and lessons learned from that pilot. And this session is to look forward to what energy as a service can potentially bring to the sector. So in terms of the agenda, we will have Ed to set the scene with the key findings from the research that him and his team have been working on for the past 18 months. And this will be followed by a panel discussion where we will have Eva, who is the executive director from Rural Energy Access Lab, and REAL are actually co-hosting this webinar series together with us. We will also hear from Isabel, who is a program manager at the Nordic Development Fund, who provided some seed funding to REAL, and Isabel can tell us a little bit more about their work in energy as a service. And we will also hear from Pete, who works with the Mission 300 team at the government of Sierra Leone, and they have got a really interesting pilot that Pete can take us through. And last but not least, we'll also hear from Patrick Tonoe, who is the head of policy and regional strategy at GOGLA. And Patrick is, with his work with different policymakers and governments, he can kind of shine a light on the wider perspectives of energy service from a policy perspective. And then there will be also a lot of time for questions and answers with all of you to be involved. The last webinar was very engaged, so I would encourage everyone to do the same this time. If you have any questions for panelists, please drop them in the chat as we go through the webinar, and I will try to pick up as many of them as we can. And for those that we don't manage to get to, we will try to answer them separately. And also, when I hand over for the first questions to all the panelists, please introduce yourselves and your organizations, because you can do it better than myself. So without further ado, I'll hand over to Ed to take us through the key findings from the research.
Thank you, Jakub, and good afternoon, good morning, everybody, depending where you are. And if we can move on to the next slide, just while that loads. My name's Ed. I'm an economic consultant sitting in the UK, and I've been involved in the energy access space for 10 to 15 years now. But this is the first time I've looked in detail at the energy service business model. I will very briefly, before I kick into our findings, just acknowledge and give thanks to the rest of the team members. So Daphne Pitts in the Netherlands, Frank Macumba in Malawi, and Julia Bulk, also in the Netherlands, did all of the hard work alongside me. I just have the pleasure of presenting these findings. So we'll kick off with a very brief sort of problem statement and sort of what we were looking at in terms of energy as a service. I suppose the first thing that we wanted to underline is that while, as the graph on the right side of this slide shows, there's been significant progress in the number of people with population with access to electricity in sub-Saharan Africa, big increase in the light blue bar. There has nonetheless been actually a relatively stable share of the amount of people, around 565 million in Africa, who do not have access to tier 1 electricity, according to the SDG 7 tracking reports. And I suppose that the key starting point for us is that, as I think Raihan had alluded to, business models like cash and sales and pay-as-you-go have reached very high volumes and are making a really important contribution to closing the electricity access gap. However, there's still obviously a long way to go. And so the more toolkits that we can sort of add to our armory of ways to address that remaining gap, especially as Raihan noted, it gets harder as you progress towards 100% rather than easier, the better. And the biggest gap, the biggest barrier obviously is affordability and ability to pay, with 80% of households estimated unable to afford a tier 1 pay-as-you-go system without some form of subsidy behind that. So if we move on to the next slide, that's where we started thinking about energy as a service. I suppose it's probably worth saying energy as a service or fee for service doesn't have to mean first time electricity access, but this study really looked at the role of energy as a service in reaching the currently unserved, so that purple wedge on the previous graph. And the difference is, well, there's lots of differences, we'll get into them. Energy as a service would provide a permanent connection, so it doesn't just reach a household once or then require repeat sales, it reaches them once and it keeps them connected. It provides a long-term service and guarantee to make sure systems keep working. And it also seeks to, or can seek to connect entire communities rather than sort of, again, as sort of Raihan mentioned, the cherry picking of the best or highest income customers first. It will go to a community and serve an entire community all at once, which has various pros and cons that we'll try to unpick in the course of the next 10 minutes or so. So if we move on to the next slide. Yeah, and if we go one further than this, I'll just talk through the sort of aim of this study. And I think I saw Jakob respond in the chat that the full report is up on the website already. So if you want to go and have a look at that while I speak, or at least find it, please feel free. So the aim is to look at energy as a service for first time community level electrification in sub-Saharan Africa and try and work out what makes energy as a service different to, for example, the models that have been used so far, particularly PAYGo and cash sales, and try to identify where there's a sort of business model difference versus a how it is funded or how it's financed difference. The objective really is to add to, we say on this slide, the growing body of knowledge, but really I think it's quite an early stage of evidence around how energy as a service can work, and in particular what it does differently in different contexts. And there's lots of sort of really interesting, innovative pilots that are trying to add more to this evidence base that we're just starting with today. And what we're going to present is on the basis of 3 sources. We did interviews with just over 20 stakeholders with a strong interest in energy as a service business model. That ranged from sort of financiers, funders, program managers, and both companies who are doing energy as a service and companies that aren't doing energy as a service to try and work out sort of why and why not. It also builds on the presentation of a few weeks ago, which is our sort of main quantitative evidence base of SolarAid's to Village pilot in Malawi. And we did a little bit of illustrative financial modeling to try to sort of tease out the differences between energy as a service compared to PAYGo, compared to cash sales, and sort of where the key differences between those business models lie. Go on to the next slide. Right, so this is the first of a couple of sort of spectrum type charts. I guess, like I said, energy as a service or fee for service is not new. And I suppose we tried to think about this on a spectrum of sort of, you pay for something up front and that's it. If it breaks, that's your loss. You have to buy a new one. You have to replace it, right through to sort of energy as a service where you never own the thing you buy, but you're paying for continuous service. On the slide, I've said there's a probably slightly tongue-in-cheek comparison to be made between white goods in places like Europe and US. You know, if you go to buy a refrigerator, a toaster, a light bulb, a fridge, for example, you can do that cash up front. You can also do it over payment plans over several years. You can do it with extended warranties. And occasionally you do find leasing models where you pay in perpetuity, but your provider promises to come and replace and service that sort of asset in your property. So all of those do, to some extent, already exist. I think the other example that isn't on the slide is if we think about how energy is provided in much of the rest of the world, you don't buy your energy system and pay a single upfront price for it. You pay quite often for subsidised access to common infrastructure, which has been often heavily subsidised by public funders to begin with. One of the things that I think we found is if you look at pay-as-you-go, and if you spread pay-as-you-go long enough, so you do pay-as-you-go over 10 years, which is still an ownership-based model, but then you start to see lots of similarities between the way energy as a service works, which is long-term sort of in perpetuity payment. A major difference even with PAYGo is that energy as a service can go in and from the beginning seek to connect an entire community over the long term, and that does provide a slightly different sort of incentive in terms of both the way you design hardware and after-sale services, and what it means in terms of ability to recover costs and generate revenues from customers, which we'll look at in the next few slides. Go on to the next slide, please. So some of the, and this is very summary, some of the key advantages and sort of disadvantages of the energy as a service business model relative to other business models like cash and PAYGo. If done at scale, because you're looking at full communities, there could well be advantages to bulk procurement and lower cost of acquisition of systems. So getting full containers in, for example, and distributing all of them into the same community or regions could be lower cost than current approaches. Similarly, and I think this is a big potential one, although there isn't much evidence yet, just because it hasn't been tried, is reduced OPEX through density effects. So we talk a lot about unit economics for energy access models, including PAYGo. There is certainly conceptually a very strong case to be made that serving an entire community and putting a solar home system on every household's roof should be lower cost to serve than having systems sort of dispersed around different regions within a country. And then for the provider, it also should be providing continuous, predictable long-term revenue streams to match OPEX. So you should be able to, sort of by connecting everybody, have a pretty good idea of what your revenue generation is going to be, and therefore how much you're able to cover OPEX and CAPEX, and if not, sort of where you need to target public funding to bridge that gap. For users, it obviously has an advantage that they don't have to stump up the cash up front for their system, so it becomes an immediate ability to pay constraint, and it can potentially offer you a lower cost per month by spreading payments over a longer time period. You also get a guaranteed service level. Your product will be taken away and disposed of safely in terms of e-waste management, and you can use your system as much or as little, at least the way the models are currently set up, because you can pay a fee to activate your system or not if you don't want to use it at a particular point in time. The risks and the downsides, I guess, to raise at this moment is much like the pay-as-you-go business model, you do, as the provider, still have to deploy systems up front, so you're incurring all of your costs of deployment at the beginning, and then you're recovering your revenue often through relatively low usage charges per household, potentially over many years. And there is, I suppose, a risk or a trade-off to be managed between the objective to reach everybody and make sure everybody can afford to use their system so that energy access is meaningful, and to do that charging low daily, weekly, or monthly fees, compared to charging customers something that is cost reflective and lets you recover a share or all of your costs, or even generate a profit margin. For end users, the risk is I suppose similar. If you end up facing cost reflective tariffs by spreading payments over a very long time, you may end up paying more over a long time period than you would have if you just bought your system up front and taken that sort of risk of it breaking. That is also not proven one way or the other. And depending on the model, which we'll talk about later, you may end up being reliant on a single service provider with less choice than a sort of classic cash. You go to your market, you pick what you want, you purchase your product sort of system. That was quite a lot. If we skip on to the next slide, this is hopefully a little bit of a break, a little bit easier to get through. There are lots and lots of ways to think about structuring energy as a service when serving an entire community. And one of the sort of key options or differentiations that came up repeatedly in our discussions was the potential to separate out the asset co from the opco. So the asset co, which owns the hardware, owns the solar home systems effectively, and bears the cost of acquisition of those systems initially. And then an operating company or several operating companies you could imagine in a particular region for a single asset co, which does everything sort of after sales on, so provides installations, servicing, payment collection, and after sale services. And then you can think about various ways that you structure the way revenues sit within those models. Either they sit within the opco with a potential gain share back up to the asset co to recoup the cost of the initial hardware, or indeed the reverse, where revenues sit within a centrally owned asset co with license conditions to unlock payments for the operating companies. Both of those come with, obviously, you'd want to think about who bears what types of risks in terms of being able to reliably access the revenues they need to be a viable structure, and sort of who wants to own each of those two types of structures. The separation would, however, allow for funding and financing to be targeted into separate parts of the business model, which would be quite different from the way energy access is often financed at the moment. The last point that we wanted to just highlight on the slide is, I suppose there is a sorry, just on the previous slide, there's a practical challenge in terms of if an operating company is the single service provider in a region, and then for whatever reason performance doesn't go well, and you can think of plenty of parallels from the PAYGo or sort of cash sales sector. Companies don't always succeed. Working out what you would do in that sort of situation and how easy it is to replace one opco with another might not be a straightforward undertaking. There might be both complicated and potentially costly measures that need to be put in place to ensure that where an operating company perhaps doesn't perform as well as intended, there are alternative contingency plans in place. Sorry, go on to the next slide. This one I will run through a little bit quicker. I think the slide sort of speaks for itself. Essentially, one of another challenge for energy services, because it's a sort of permanent payment model, and therefore is recovering revenues over an even longer time frame than a business model like PAYGo does. The more you intend to recover your initial upfront costs by spreading them over that duration of sort of a permanent or a 10-year horizon, the more you're exposed to long-term risks of change in values. So that could be if locally financed inflation, and the chart on the left shows that, taking Malawi as an example, if we look over the last 10 years, one kwacha in your pocket in 2024 is only worth 30% of one kwacha 10 years ago. So if you're funding yourself locally, if you get your money back 10 years later, it's worth a lot less to you. And similarly, the light green line shows a similar story, but for exchange rates, where again, if you were financed with repayable US dollars at the beginning of a 10-year horizon in 2015, your kwacha revenue streams would only be worth about 20 to 25% of what they had been worth 10 years ago. So depending how you fund or finance energy as a service, you have a challenge with exposure to long-term risks. And there's a question of sort of whether companies, and in particular end users, should be exposed to those risks because they're going to be very able to bear them, or whether somebody else is prepared to pay down those sorts of risks from the get-go. I just have a couple more slides to run through quickly. So I'm going to go a little bit back to sort of one of the things I think I hope I said at the beginning, which is there's obviously a lot of space left in trying to address the electricity access gap. Energy as a service should be seen as a part of that toolkit. We think it's not the only solution. It doesn't have to replace cash or PAYGo entirely. There's certainly a very low risk of over-subsidizing or unfair competition if you start at the far end of the spectrum and say we're going to go to the hardest to reach, costliest to serve, lowest ability to pay communities first. We're going to do those with a sort of energy as a service concession where we serve everybody in those communities who would otherwise all be left behind. And then in the middle of the graph, in the sort of light blue double arrow at the top, there's probably a middle continuum where there's something still to be worked out around when and how does PAYGo compete or cash sales compete with energy as a service for solar home systems? In particular, if one of the key advantages of energy as a service is serving entire communities, which might require some sort of restriction of competition. So does energy as a service still work if you've got to go into communities where some households are buying cash up front, some are buying on PAYGo, and some are signing up to energy as a service? I think that's probably an open question, but it sits in the middle of the sort of spectrum. There's still a tail end where that issue doesn't arise. If we go on to the next slide, I'm not going to read through too many of these. These are quotes, so I'm hoping people read them to go through. I might do the start of the journey and then the end. I guess one of the things that came out really clearly, particularly from funders, is we clearly need to accept there will always be a need to subsidize some customer segments. And the point here to really underline is this is true everywhere in the world. If you look at electricity access in the UK, for example, where I sit, not all customers face cost-effective tariffs. Some customers get preferential tariffs. In a full energy system, you can do that partly, at least, through cross-subsidization to help fund subsidies for lower-income customers. That's much harder to do within a single utilities operation in many sub-Saharan African countries, but it's not to say that we shouldn't acknowledge that there are customers who won't be reached by commercially priced products and business models. And then right at the end of the journey, I guess the key thing to underline is the circularity of energy as a service being a big selling point. It's not about selling products and selling lots and lots of units and then not knowing what happens to them to them afterwards. It really is an approach which has to embed sustainability as part of its supply chain, and that makes a lot of sense, particularly when you're looking at electronic products with sometimes reasonably short lifespans otherwise, that could otherwise create quite a big e-waste and end-of-life challenge. So again, 2 more slides on, and this is then my last slide, just of a few of our sort of, we've said learnings and recommendations. I think these are things we probably don't know enough about, and the more pilots, the more evidence that can be generated on this, the better to help support and target the energy as a service business model. The first is generating more evidence on the cost effectiveness of life cycle servicing. So in particular, anything that helps unpick sort of over 5-10 years, and we don't have to wait for those 10 years to happen, but just to understand how much does it cost to replace tier 1 solar home systems. Can that be done cheaper than, for example, replacing entire systems? What can be done in terms of innovation in hardware, longer battery lives, more modular systems, and how can that help bring down the cost of a sort of permanent energy access and servicing model? The second is understanding, sort of proving out the concept of how costs vary by key cost centers as scale increases. So while we're conceptually sort of convinced that servicing entire communities could well be lower cost per unit, we don't have a lot of evidence to prove that point out or to understand by what order of magnitude that changes your unit costs. The third is maybe the flip side, which is to think about and test pricing structures, like I said, to trade off making sure everybody can and does afford to keep using their system versus making sure you're generating enough revenue to pay back your costs. The fourth one I talked about, piloting options for ensuring swappability of opcos so that there is some robustness in terms of if you have to change providers over a 5 or 10 year period, how easy is that to do? And then the last two are perhaps more a sort of plea or request for others on this call to think about as well, which is to think about what is the structure and type of funding and financing that energy as a service needs. It is a different business model from the existing options, and for that reason is likely to need to be funded and financed differently, particularly, I think, as I said earlier, with more of the funding coming up front to help buy down some of those long-term costs. But then there is still a bit of work we think to be done in terms of working out, you know, where can you then crowd in slightly more commercial or entirely more commercial forms of finance? Is it into the asset co? Is it into the opco? Is it into both? And how do you structure that to provide a sort of fair rate of return, leveraging public funding where needed? And then last but not least, should probably come first, when we started about a year ago, there were quite a lot of terms being used in different ways. And one of the things that sort of we certainly struggled with and discovered when we were doing our interviews is people see the energy as a service business model quite differently. And so building consensus on when it is intended to be used, for what communities, which funders should it be attracting? Is it, for example, I'm sure someone else might speak to this, pre-grid electrification? Is it a permanent solution? How can we describe those things in a way that is consistent is probably really important to work out as well, so that we're all talking about the same things using the same language. And I think I'm going to pause there. I hope that's done justice to the long report, but as you can now see, there is the full report on the screen, if that's whetted your appetite to learn more. Back to you, Jakob.
Thank you so much, Ed, and everyone is very welcome to download the report, which I've also dropped it in the chat. So that's kind of the formal scene setting from Ed finalized, and now we will move into the panel discussion. So if I may, I would like to start with you, Pete, since you have been involved in the government of Sierra Leone's Light Salon pilot. So if you would be happy to maybe briefly introduce yourself and your role, and also give us a little bit of a flavor on your pilot, that would be fantastic. Thank you.
Okay, thank you very much, Iriba. Yeah, my name is Pete Kindane. I am the National Coordinator for the Compact Monitoring and Delivery Unit, the CDMU, the Compact Delivery and Monitoring Unit, housed in the Ministry of Energy. This is for the M300. Yes, we have been involved a lot with the government of Sierra Leone's interest in the home systems, the solar home systems, because as a country, we realize that it is difficult to reach the last mile, and this last mile definition for us is not only about the geography, but also the ability to make these payments. First of all, let me start by saying that we are very pleased to participate in this webinar because it is important to have different views on this experiment we are undertaking, and also to have an open discussion. So I would like to first of all put that up front before we go on. The SHS definitely play a very important role in accelerating access in Sierra Leone under the third pillar of the Mission 300 Compact. So clearly, the government has shown interest in ensuring that the SHS is given prominence in the compact itself. So therefore, this is very important for us, and that is why we are here. Let me talk about how Sierra Leone intends to do this. Maybe Eva, you want to display the 3 slides I gave you. I'm going to make this very short so that we have opportunity to discuss.
The slides are on the screen. We are now on the lights alone slide.
Okay, you are there now. Okay, thanks. All right, so again, we are aware that because of the geographic location and the ability to pay, even if we are to succeed with grid, all our grid projects up to 400,000 households, we still not be on. We still not see light, literally, if the SHS system is not accepted, because this would ensure affordability and sustainable energy access as an objective of government. The current system we have using the rent to own are out of reach for a lot of these people we intend to provide energy to. The government's vision, therefore, in this case, is to ensure we have a large-scale SHS infrastructure program, and which will provide the necessary sustainable SS-based energy access for a highly affordable monthly service fee. The model itself is now being piloted in Cambia district, and government has seen how this has affected the lives of the people and how it has aligned with its own priority to ensure that from 26% as at today to 75% accessibility by 2030. And the vast majority of this is going to be through this system. The light salon model will be scaled because of the success it has shown. And this will therefore mean that we will deliver the 400,000 last mile connections within the specified period of time. Obviously, this does not come free of charge, and it has a price tag of nearly 100 million United States dollars. Next slide, please. Yeah. The light saloon as a sustainable infrastructure model for the last mile is very appealing to the government. The concept itself was developed by Real Easy Solar and the Irish delegation, for which the government of Sierra Leone is very much appreciative. As at now, over 10,000 systems have been connected in Cambia district alone. Will have been connected in Cambia district by the end of next month. This, therefore, will lead us to install these systems in the communities as an energy as a service model. The households will pay approximately $2.60 to access the system, which would, but this does not lead to ownership, which has its own advantages. Easy Solar, which is a private company, installs, operates, and maintains the system. And then there's an NGO at the moment which operates as the interim asset owner. So that's the model that we have in Sierra Leone. Next slide, please.
If you could wrap up in 1 minute, please, Pete, that would be amazing. Thank you.
Okay. Yeah, sure. Certainly. As at now, our scaling vision, by April, we would have launched a public-private partnership. The official announcement of this was will be done in was done in Onga last year in New York, and the government of Sierra Leone and its partners are working on designs of the energy access facility, because we believe that as we scale up, it is important to have this. So for now, we are working with REAL to make sure that we can identify an easily scalable asset co-structure for multi-donor engagement. I have already mentioned the fact that we require a lot of funding for this, and obviously a large-scale subsidy program for all our solar home systems is thus needed to ensure that rural households are not left behind. Over. Thank you.
Thank you so much, Pete. And on the note of financing, I would like now to hand over to Isabel So Isabel, if you'd be happy to please briefly introduce yourself and your role at NDF. And if you could elaborate a little bit on what role can blended finance play in making energy as a service viable at scale?
Sure, thank you. Hello to everybody. I'm Isabel Leru from the Nordic Development Fund, and I'm extremely happy to take part of this important discussion. And well, firstly, as a bit of a background on NDF and how the topic of energy as a service relates to our work. So NDF is a joint international finance institution of the Nordic countries, and we focus on the nexus of climate change and development. We have just recently launched a new strategy, Strategy 2030, and our goal is to maximize the added value of NDF's risk-tolerant, flexible and concessional financing by mobilizing capital, innovation and risk-taking to unlock transformative solutions for really the most urgent challenges and vulnerabilities in lower-income countries, and with a specific focus on sub-Saharan Africa. NDF has been investing in the clean energy sector since 2017, and during this time we have built quite a diverse portfolio of interventions, which includes first loss junior capital investments in various blended finance facilities that are investing in companies primarily operating in sub-Saharan Africa through a range of different instruments, from equity to local currency loans to hard currency loans and to technical assistance grants. One of our key interventions is the EEP Africa, which I'm sure that many of you know, that provides early stage catalytic grant financing to clean energy companies in Eastern and Southern Africa. And in addition to these, we work also closely with our long-standing partners, the African Development Bank and the World Bank, really supporting activities that foster enabling environments and also build local capacities. And during these almost 10 years that we have been active in the sector, we have, of course, seen the evolution of the market and of the clean energy sector. We have seen the challenges, we have seen the pain points that companies and their customers and also financiers and donors have experienced. Surely there are many lessons learned and many experiences that from different perspectives, but most importantly, I think that we have an understanding that there really needs to be forward-looking and pragmatic thinking on how can we really achieve positive structural and sustainable changes in the systems. And being a concessional investor, financier, and focusing on climate and development, we recognize that there is a rapidly escalating climate crisis, there is increasing pressure and competing priorities in development, in official development assistance. There is really an urgency to address the ambitious goals to achieve universal access to energy, and also the economic empowerment of communities are really being left behind. And we need innovative solutions and collaborative action to address these. So from this, it is in this context that the energy as a service concept really has gained our attention, our interest, because we do see that there is that potential to address the challenges that are still remaining and really remain very urgent, specifically in remote, the poorest communities, and that still lack first-time access to energy. So our point of entry into this discussion is really also about thinking how can we then design innovative interventions. How can we mobilize capital? How can we use concessional financing to leverage and to mobilize capital that is then channeled to operating models that can then bring, of course, efficient and sustainable clean energy solutions to the hardest to reach communities. And when we think about blended finance, what's the role of the blended finance? Our thinking is, okay, so what do we as concessional investors, but then other types of other investors as well, there may be some commercial-like investors, what do we need to be assured that this is something that can be financeable, it can be investable? So, of course, there are already many different mechanisms that have been financed along the years by donors and by development finance institutions, range of different instruments that have been used, and it's important to understand, okay, how would the energy as a service model sit in this already existing ecosystem? what are the lessons learned from the successes, from the results, from what has not worked, what has created distortions, for example, in the market, and how can we then use this information to build that understanding, okay, what is the role of the energy as a service in this ecosystem? And I think that we need more public data. We need more common understanding on what has worked, and particularly from a public financier perspective, it's important to understand also then, okay, how can this model also ensure that there will be positive incentives to the market, that there will be market distortions will be minimized, and also ensuring that the results are sustainable over time. An important part also, I think one of the findings of the study also is that the energy as a service model complements other existing models. So I think that's also very important to understand for us financiers. So okay, so what works in which context, and for example, what are the contexts that the energy as a service model would work better? So I think that there's already a lot of information on that. Then how would we then how do we articulate how these energy as a service interventions will bring kind of the missing piece to the mix? So ensuring that there are these objectives that can be then also achieved. Maybe then another point that it's important to point out is that there needs to be the design of the model needs to be well articulated so that it is something that actually can be replicated, can be scaled up in different contexts. So in this part, the ongoing pilots that have been presented are very important, because these are, of course, providing important information on the design of the services, on for example, the cost and revenue models, technical specifications, and topics that are very important to donors and to DFIs is on the repairs and maintenance, on the e-waste management, which are still topics that remain to be, that have not been solved yet in the existing models. Then what comes to the design of something that can be, of a facility that can be set up, can be then scaled up and replicated. While there is a very clear understanding that at the early stages this will be heavily financed with concessional capital, there needs to be, it is important to have a well-defined path for scale up and growth. So for example, understanding that going forward, what is the level of aggregation that is needed to reach sufficient economies of scale? And most importantly for investors and financiers, what is the scale that needs to be reached so that there is adequate risk mitigation, risk diversification that will at some point over time enable the absorption of capital that requires some form of repayment or return to investors. So here we come then to the design of the facility. It's important to design a facility that can attract financing from different types of financiers, and then what would be the structure of the facility. So this thinking around, would there be a division between the asset company, the operational company, but then also importantly, what would be some kind of umbrella structure that would be then channeling financing to different countries, because that from a risk diversification point of view, it's very important for financiers. Then finally, on the design for financiers, it is important to ensure that the design is aligned with financiers' expectations and requirements in the context, for example, of capital deployment, governance, transparency, compliance, monitoring and reporting, and so on. But maybe lastly, as the blended finance universe is something that has been really evolving during these past years, it is also important to look for new sources of financing, for emerging sources of financing. So really also understanding that there is that pressure that public donor concessional financing might be decreasing over time. So how can we then also mobilize over other types of financing into these blended facilities? Thank you.
Thank you so much, Isabel. And without prompting, you actually answered many of the questions that came up in the Q&A chat already, which is fantastic. There was actually one follow-up question that asked about specific structures that you have supported, which is a perfect segue to Eva to talk about the Rural Energy Access Lab, which of course has received a booster grant from NDF. And Eva, if you would be happy to briefly introduce REAL and also to elaborate a little bit on what the role of public-private partnership in rolling out energy service is, if you see any role for REAL with that specific model. And that's also one of the questions that actually came up in the chat. So over to you.
Sure, thanks everyone. So to introduce REAL, and many of you may have heard about it from sort of early days when it started off first and foremost as an advocate for this model. We called it the Real Energy Access Lab. Today, we've moved on to calling it the Real Program Catalyst, because we feel like as a lab, we've already achieved quite a lot in terms of advocating for this model. I think this attendance at this webinar and the level of engagement really speaks to that. So we're very happy about it. But REAL as an organization is really solidifying its capacity and expertise, and it's working to become a much more hands-on not-for-profit program developer. We see the role for REAL the important role to achieve the scale that we want to see is to support governments and their development partners across sub-Saharan Africa in designing, funding, implementing large-scale programs to reach specifically the last mile. So we don't think that the current models are sufficiently addressing the problem. We are focusing on this energy service-based model, particularly SHS at the moment. And we think that REAL needs to be this hands-on, dedicated specialist organization that can help demonstrate pilots at scale and also help to design these structures and kind of do all the development work at the national level to then allow others to plug into it. So it's a much more sort of partnership-based model, but it starts with a very strong view of a public-private partnership, as Jakob, you were saying. So at the moment, just before I jump to that, to finish on REAL, we're working with 3 pilots, one of which is the pilot in Malawi, where we are partnering with Solar Aid and Sunny Money as the operator. We are working with Easy Solar, a private operator in Sierra Leone, and we're working with Moon in Senegal. And as Pete was mentioning, we are also starting to work beyond the pilot level at conceptualizing the sort of structures for the national scale-up in Sierra Leone and starting to work with the government of Togo as well. So there seems to be a lot of interest. We're learning as we go, but coming back to the point about the public-private partnership, it is really at the core of where we see the scale happening. So first of all, we are talking first and foremost about long-term utility-like service. So for that, I think naturally it brings up the point of needing a public-private partnership. There needs to be a clear policy commitment first and foremost. This is why it's so exciting to see the partnership with the government of Sierra Leone, which is really championing this model. With regards to policy, and I saw a few questions in the chat related to zoning, for example. So for this model, at least for now, we have not worked with any hard concessions, but zoning is quite important because penetration is key. I mean, what we are trying to achieve is to enable a model that supports sustainably operations over a long period of time in some of the hardest to reach areas. And for REAL, this is critical. So far, we have worked with a model that looks at very high capex subsidy, but then trying to prove that once you reach certain scale, and scale implies both the number of systems in a specifically defined area, and as well as the high level of usage of those systems, because as was mentioned, the customer basically has a choice of whether and how much to use them. So these aspects are very critical for us to ensure the long-term financial sustainability, which we are trying to prove. So within REAL strategy, we're looking first at scaling you could call it a large pilot. We call it an MVP, or a minimum viable program, to show that you need to reach a certain scale for it to make sense, for the operations to be efficient. And this is where the question of zoning comes in, and hence a very strong need to work with governments. I mean, we really see this as you could call it a rural utility model. I mean, effectively, I think what is very attractive to governments, and I would say one of our learnings is that it is indeed very attractive to governments. This is why they're so interested in working with REAL on seeing first the results from pilots, but then conceptualizing how it could be scaled. It's because it ties very well into their long-term policy planning. I mean, effectively, we are providing, you could call it pre-grid electrification, you could call it first access, but it's really the first comprehensive step of electrifying entire communities, which provides you a lot of data, first of all, which can feed into further policy planning. It also trains the customers in how a utility model operates. It sort of makes them, it allows them to develop the practice of paying for energy as a service, paying a fee over a long period of time. It allows them to develop that kind of credit record. All of these are very critical aspects for them to build onto the offering. I can speak a bit more about that if that's of interest. But so from a policy perspective and working with governments at that level is very important. We are also looking beyond that, but the exact structure can differ. So the public-private partnership is a broad term, and the exact structure can differ on a country-by-country level, depending on the specific circumstances. So far, we are looking at the model where we would separate the asset ownership and the operations. And depending on the, again, specific circumstances, the government could be involved in that. This relates to the question of financing as well. So, if we are talking about either 100% capex financing through grants, or, for example, the government being involved in securing other type of more concessional funding, then naturally their role would be higher. It doesn't mean that they would manage the asset co, but they would play perhaps some role in the governance. So it could be lighter touch and more responsibility placed on the private sector. It could be a heavier engagement, but in one way or another, a public-private partnership is really at the core of this model from our perspective.
Thank you, Eva. And if I may turn now to Patrick, Eva mentioned that there's a lot of interest from governments on energy as a service to include it in their national electrification plans, and there more and more governments are exploring this model. So Patrick, you work a lot with governments and policymakers. Do you agree with that statement? And if you do, why do you feel like there's now more interest in this model? And any other reflections you may have from your government relations would be helpful.
Thank you, Jakub, for that question. I think just to answer directly, of course, there's a lot of interest in this, and I think we need to also step back and look at the bigger picture. The issue about the affordability and who we can reach using the current electrification approaches, the grid, mini grids, SHS are clear, and why trying to minimize the cost of access for the end users who can least afford is clear, and how energy as a service would fit in. But I think also when we look at the questions that government and also development partners ask of especially the off-grid or the DRE standalone sector, it's asking about, is this going to be sustained access, right? So what are we providing systems to consumers that we have to come back at a certain point? So how can we be sure that this is sustained access that you can deliver over the long run? And also assurance about the quality and everything else that comes with it. Some of it is neatly answered in some of the other solutions, but in others, there's not a very, very, not, should I use the word convincing answer that they're buying on those. And I think the potential to provide access to communities and that this access is sustained over a long period will be quite attractive to a lot of governments who are also looking at this. I think there are also some other benefits when you look in the long run about the ability of consumers to grow up, and whether this will scale up the energy access ladder, and how is this enabled by through a system like this. And I think overall you'll see that within the energy landscape, where you're trying to make sure that consumers have access to quality services, that they have also have sustained access over long term, and also how do we make sure that we don't leave anybody behind. This is part of that solution set. I think as we also go forward, particularly speaking from the private sector side, one of the things that we need to be very transparent to development partners and also to governments and really have a frank conversation is while the industry will be pushing to make sure that the business model, the way they operate, is as efficient as possible, to strip out all costs and make sure that it's accessible, reliable, but as cost effective as possible. I think in many cases, the development partners, governments, and regardless of we're talking DRE, SHS, and all underestimate really the cost and the investment, those cross subsidies, what will need to be done to especially reach everybody. I think we've been noting, for example, in the size and scale and ambition for SHS, for energy access, they look at a small subset and think that you can catalyze this and then move away. And I think that what's being piloted and the question being raised in Sierra Leone is this ambition to reach everybody and really having a true cost, understanding of the full cost to be able to do that. And with that commitment, then yes, you can. But otherwise, if you don't invest in it, then you prove the model, but you fail to scale. Back to you, Jakub.
Thank you, Patrick, for your reflections. And also thank you, everyone, for your meaningful engagement in the chat. It's really great that people are constructive and having quite deep dives into different topics. So we'll try to cover some of these questions, but we might not be able to answer all of them. I know that Raihan mentioned some questions that I think still need to be proven or more tested, but it's really important that we are having this dialogue so people can learn from each other's experience, which brings me to actually the experience of the private sector and the practitioners on the ground. So I was wondering if I could maybe bring in very briefly Christian from Bamboo, who have projects in Mozambique and Madagascar, to share just very brief reflections on some of the lessons learned from the energy as a service pilots there. Christian, can you hear us? Yes, please go ahead.
Hello, nice to be here. Thank you for organizing this webinar, which I think is very important. And thanks also for organizing this research paper, because what we really need now is we need more data. And I will talk about that in a second. So maybe just quickly to tell you how we come into the energy as a service world. So Bamboo Capital Partners is managing several sector development funds, so grant programs with funding from World Bank. So we run a program in Madagascar, in Mozambique, in Burundi, Niger, in Haiti. But we're also so we do the typical RBF programs for PAYGo sales. But we are also looking now into new models, and we have launched an energy as a service pilot in Madagascar, and have also launched the first phase, what we call first piloting phase, to test energy as a service models in Mozambique. So we are really in the process right now of testing those models. We have limited data so far, but it's happening as we speak. But I wanted to give a bit of a larger picture here, because I don't know if some of you remember, but about 10 years or so ago, there were a few companies like Off-Grid Electric and Bbox who started with the perpetual lease models, which is effectively energy as a service for small solar home systems. They all shifted towards the rent-to-own structures, and the reason was that the energy as a service models were far too working capital intense, and they came, of course, also with far too much FX risks. But most importantly, at that time, there were no grants available, and it was impossible for those companies to maintain their model, and also impossible to target poorer, more rural areas. Now, we see this model coming back, and one of the reasons is that the sales model, and that was said before, is not able to to cover the entire market and help us reaching universal electricity access. The commercial PAYGo model has its limitations, we all know. And we as sector development fund managers, we feel the pressure from governments and from funders like World Bank that we need to come up with solutions that allow to reach those people who are not addressed by the current market. So energy as a service is definitely a model that deserves attention, and we're testing that right now. But we are in a very early stage. So there are few, I think, principles that are critical. First, in our opinion, we should, at this point in time, avoid creating complicated concession frameworks or any additional layers that would slow down the deployment of energy as a service, because unless mini grids, there's no heavy infrastructure, there's no distribution capex. So we really believe that the model should remain as lean as possible in this initial phase, so that we can deploy quickly and see what works and what doesn't work. Second, I think it is probably too early to think about splitting the asset ownership from operations, because that would risk creating some misalignment, because especially around maintenance, system replacement, customer management, etc. And keeping that alignment between the assets and the operations is essential at this phase where we're still learning, right? And third, and most importantly, what we really need to test now is, and we need to test that in various different settings, is whether this energy as a service model is truly sustainable. And that means that customer revenues must cover the OPEX and replacement costs. If that is not the case, then we would require operational subsidies, which would mean that the model will never be able to scale because we can't get that much grant funding. So we can use grants to catalyze the deployment, to pay for initial capex, but they cannot be used to permanently finance operations. So we will need to test this in different settings, and we will need to understand whether we need different grant levels, what are the payment patterns in different areas. I think we're going to see quite a variety of learnings in different countries and different rural areas. And that will help us refine. But what we really need now is data. We need real field data. We need to understand payment behaviors, replacement cycles. We need to understand how we can optimize the grant capital, and we need to have a better understanding of all the OPEX of those models. So we are in that experimentation phase, and in a very quick summary now, the key message here is keep it simple, lean, and test. That's what we need to do now.
If I can just jump in, Jakob, very quickly to respond to Christian. I mean, I think we're very much aligned on keeping it simple, and this is where, you know, Real's model has been also focused on this sort of simple structure of funding the capex and trying to reach the scale where that project becomes financially sustainable before looking at a larger scale sort of national structure where perhaps blended capital might be, you know, doable, etc. So we're also very much aligned there. Just on the data, I mean, this is what, you know, I think this is the value that NDF, by supporting Real, also saw in this. It's that we are trying to make sure that we capture that data, and we work with the largest, I believe, pilots of energy as a service on the continent today. In Sierra Leone, we're hoping to reach 17,000 connections by the end of this year. In Malawi, we have 10,000, and we're hoping to double it by possibly next year. And Senegal is a little bit smaller for now, but with all of them at about just over 4,000 connections currently. With all of them, we're collecting data, and we are working on, Real is working on what we call a blueprint for the rolling out. So the rolling out and the operations, so not only the design and structure, I mean, I talked about our role in sort of, helping to think through that dimension, but it's also very much about looking at, as you were saying, and testing new approaches to payment patterns, and what affects them, how they should be batched, or sort of what the offering should be, what matters in terms of ensuring high usage, what operational team structures work best in what kind of settings. All of this is something that we're collecting. Again, as again, Christian, you said, we also believe that first we need to reach that MVP scale to really tell everyone that this can work, and fully support the operation. So that's our top priority. But in terms of data, we hope to share some of it as early as next month, maybe a very initial glimpse, because again, the scale is not yet there. But we're definitely learning a lot. So we hope to do more of this knowledge sharing over this year. Thanks.
Thank you, Eva, and thank you, Christian, for your intervention. I think, like you mentioned, this model is not brand new. We have actually got, I believe, David Orozco, who mentioned that they've been working on energy as service in Peru for the past 20 years. So it's fantastic that we can learn from each other and try to improve the existing model rather than trying to start from scratch. I would like to hear one more reflection from the private sector, from Camille, from ANCA. Camille, it would be helpful to very briefly introduce your company, your energy as service experience, and also if you already have any data that Christian mentioned in his intervention that could help us to answer some of the questions from the audience. Thank you.
Thank you, Jakob. Thank you, everyone, and happy to be here. That's very interesting, and actually, there's a lot that has already been said. So I feel like I'm only gonna cover with real field experience some that has been covered. I can talk about our experience in Madagascar with energy as a service, and we can probably reflect on some questions and some comments that were made earlier. Christian, obviously, I will be just illustrating what you've been working on in Madagascar. So just very briefly, my company, I'm the CEO and founder of a company called ANCA. We are historically established in Madagascar, and we're known to be a infrastructure specialists. So we do provide generation assets and distribution, energy generation assets and energy distribution assets for both CNI customers as well as communities under PPA agreements with local governments. So that's what we're talking about here. So we're used to work with mini grids and to provide electricity as a service through these infrastructures. And about 2 years ago, we started having conversation with the company Moon, so the French company that was pictured in some of the presentations, to try to see if it would make sense to combine pre-electrification, or whatever you want to call it, as Yawa was saying, to mini grids and energy provision through these infrastructures in one same model. So what we've developed for the past year or so is a model where we combine both the approaches. So we do install mini grids and sell electricity to end customers, and to increase the penetration rates and to try to target those very vulnerable customers, the tier 1 customers that usually cannot get access to the grid. We developed this energy access solution. In the past, we tried working with PAYGo models and to distribute kits on different and various models, cash payments, PAYGo, and so on. But none of this really fit with our philosophy and the way we were used to work. And so we were very attracted in the EaaS model for several reasons. I think that one, obviously, is the model itself. We are closer to the philosophy of selling an energy service to the customers, but also in terms of technology, even though this may not be the primary and most critical point in everything that you're doing, because at the end of the day, it's less about technology than model and financing, to be honest. But we did realize that relying on solar kits for basic energy service that were very robust, repairable, and that could last longer because they were designed to last long and to be sustainable in the long term, were a real plus and a real advantage to go on the ground. I mean, obviously, what we observe is that those low-income customers, they have difficulties affording for the PAYGo systems or the acquisition of such devices. And so the question that came to our mind was, should we really make basic energy access a burden for customers that don't even have the credit capacity to pay at all in the first place? And so that's the mindset that we came up with while designing this project of combining mini grids and energy as a service solutions. We talked about the structuring. So in our situation, that's something that was mentioned earlier. We did set up an asset co. I heard about the accountability and the alignment from the operator and how this could become a risk for the operation and the maintenance and the quality of the service over time. In our situation, Anka, as the opco, also is a shareholder of the asset co, which does bring, I guess, more certainty on the level of quality and involvement on the long term. This asset co owns the assets, and the opco is contracted to service, to maintain, and to sell the services to the end customers. We started the pilot about a year ago, thanks to funding from the World Bank, and this is the facility that Christian was talking about, which was managed by Bamboo. We started with 2,000 kits that we deployed. With very good results. This is the first year, so as everybody seems to be saying, this is a learning curve, and we are learning from this experience, but we've already acquired and we already have in stock 5,000 more kits, and we've been awarded on several funding windows to go up to 20,000. But what we're navigating at the moment is different existing financing mechanisms that are not entirely aligned with the energy as a service model. So what we do need in order to go at scale, and I think that this is one of the most important aspects that was quoted by a few persons during this conversation, is that this model is a mass deployment model. So the only way we can truly confirm that this is a viable model on the long term is that if we pass the threshold of a certain scale and go at large scale. And we do have this possibility. Just take this example. We do, in the pilot, we have in the surroundings of one mini grid that covers, yeah, thanks. In the surrounding of one mini grid we have, which is roughly about like 400 kilowatts capacity PV, so this is quite a large mini grid. We are providing electricity to customers in the range of 4 or 5 villages that are connected to the same grid. Thanks to energy as a service and the kits that we're deploying under this model, we're reaching about 30 new villages and providing basic energy service to hundreds of new customers. This can be used to as a, I just say, starting point for basic energy service in the view of expanding the mini grid. This can also be used to create and stimulate energy demand in order to more properly assess energy needs for the projects and especially mini grids, for instance. So there's a lot we can talk about. I know I have to stop now, but yeah, just sharing the experience that we had in Madagascar, and happy to answer any questions you may have. Thanks.
Thank you so much, Camille. And thank you for everyone, again, for your questions in the chat and the engagement there. I'm sorry that we won't be able to answer all the questions there, but I see a lot of discussion going on there, which is fantastic. And that's what the lab is meant to be about. And that's why also we try to give voice to so many people today, because there's probably no one on this call who has all the answers. So that's why we try to share different perspectives, whether it is from the private sector, government, practitioners, funders. Raihan, I wonder if I can maybe turn to you. You post some questions in the chat at the beginning that these are kind of crucial questions that still need to be addressed. I wonder if there are any that you feel like we have got a bit more clarity on, and what are kind of the main ones that you feel like we still really need to answer before we can potentially consider scaling this model further.
Well, thank you, Jakub, and let me thank you for moderating this session so nicely and efficiently. And thanks to all the presenters and the practitioners who came in, shared their views, for all keeping in time, but focusing on the questions and giving us a very solid answers to issues that we know of as of now. And I was really happy to read through the discussions. I mean, it's a very vibrant discussion. It actually tells us that this is a model which we are testing. There are some lessons out there. The question is how we can scale it up. That, I think, is the key question that we are trying to figure out. I think one of our colleagues have also mentioned that energy as a service is not a new model. It was tried before. I would go a little bit more than that. I would say that energy as a service is not at all, and it's an old school model. The reason I'm saying it, because even today, in your house, when you pay your electricity bill, it is an energy as a service model. So basically, we are all used to energy as a service model when it's large infrastructure. But I think when it comes to the small mobile phone or small solar lanterns, we thought, no, we have to own it. So that's why I think there is this debate about ownership and lack of ownership or service. But at the end of the day, I think people want to get service with a price that they can afford. And if we can offer that, I think we have a solution. So either, I think, cash sales started, but pay-as-you-go came up with a solution which maybe dollar per kilowatt hour was more than cash sales, but people were able to afford it. My first question was that probably dollar per kilowatt hour would be much higher on energy as a service model compared to pay-as-you-go, but maybe it will be at an affordable level for people who can't even afford pay-as-you-go. Those are the financials that we have to be sure of as we launch energy service or want to scale it up. The second thing is that we are also hearing the need of grants. And when it comes to the need of grants, I think we can all depend on philanthropies, or we can depend on venture capitals, which are not grants, but money comes in. But when you really need to depend on grant and scale it up, I think we cannot ignore the impact of governments and coming in and supporting or providing financial support for their own people to get electrified. And all the projects that we have tried to fund from World Bank, I think the biggest challenge we had with governments is that they wanted to know why should they provide grants to private sector to sell some solar kits, which could lock the customer into a tier 1 level access. That was the biggest question we had to respond to. Then the question is, can these people go up the energy ladder if we provide a grant to a tier 1 level access? We don't have enough response to the government when they ask what happens at the end of life of the products that private sector sells, either as pay-as-you-go or cash sales. And then those are the areas which makes them hesitant to allocate funds or grant funds to the grid, the utility part, with grants, with concessional money every time. But when it comes to off-grid solar and private sector, we see some resistance there. And I think those are the areas we need to see how we can make energy as a service palatable to the government, how we can make them own this model, because if they can support utilities, grid utilities, can we find a model where either through separation of asset companies or operating companies, how can we get the government engaged in? I know we are all focused on making things simple, and I'm not favoring making things complicated, but the question is, the simple things are better when we are doing a pilot, when we are testing a model, but when we are trying to scale it up, we need to see what are the key constraints and what could solve those issues. And if we can do that, then I think we can really move up to scale. So that was my key takeaway from the discussions that I'm hearing and the discussions at the chat box. I think it was a very good discussion to presenting energy as a service as a model. But I think it's at a stage where we need to do more work, more pilot, more projects need to try it out. And then the lessons from that, maybe through End User Subsidy Lab or Energy Savings Trust and others, we can try to see how we can gather those lessons and get government as a party to all this. Because even in this discussion, I would have loved to see some government partners also present, some ministries to be present, some rural energy agencies to be present, so that they could also share their views, what their challenges are to embrace these off-grid solar models. So with that, Jakob, I would like to close the meeting, but at the same time, just also want to say, I have already thanked all the speakers, but I also want to say that all the documentations would be provided through YouTube and through Energy Resource Hub, so you'll get access to that. And any questions, feedback, ideas that you may have, please reach out to End User Subsidy Lab, and Jennifer Tracy and Federico Hendricks are the key point persons to whom you can reach to. So I think with that, Jakob, let me again thank you all and thank all the participants for this. And maybe we are also at the 10:30 hour, so we can also close the meeting if you want.
Perfect timing. Thank you so much, Raihan. And thank you so much again, Evan, for joining, to all the speakers, and to Brenda from GOGLA, and Jenny and Fede from SMAP for helping to put it all together.
Thank you all.
Bye, Evan. Thank you.
Thanks, everyone.
Thank you.
Thank you, everyone.